You know, if you had just parachuted in at the end of 2014 and looked at market returns, at least in local currency terms, pretty much everything would have been positive. But that would have belied a very divergent nature in the world economy and in capital markets that all of us have experienced. And that theme of divergence is likely to continue as we move forward, even within global growth. Overall, moderate but improved, but if I fan it out by countries and regions, among the developed space, the US and the UK should lead, Japan and Europe should continue to lag, and that flows through to the inflation story. Overall, developed market inflation should be relatively benign, but while the US moves further away from deflationary fears, the BOJ and the ECB are still right in the thick of it, and that is translating to liquidity, where the US is done tapering, but the BOJ will continue to add stimulus, and here comes the ECB. From an official rates perspective, that's where we expect the US and the UK to tighten, while other nations such as China and Australia are likely to cut. If I am talking about divergence, though, I have to touch on probably the most divergent story of 2014, and that's the decline in the price of oil. Surging US production has changed the supply-demand balance, and that's resulted in an enormous wealth transfer between those nations that produce oil and those nations that consume oil. Front and center there is the United States, where this acts as an enormous tax cut, particularly for low and middle income earners who use a larger share of their wallet on energy. And those gains are dovetailing with an already pretty hot US economy. The underemployment rate has fallen, the unemployment rate has fallen, but of course there are stories within the story. For example, in the unemployment rate, 2.4 million jobs were added in the first 11 months of the year. But if I throw in revisions, as well as equivalent jobs from a longer work week or higher average hourly wages, I get a tally of over 3.3 million jobs equivalent. And that's showing up in GDP. It's been accruing for some time, but the third quarter had a revised number of 5%. That's the largest gain in over 10 years. And we expect that strength to continue because a lot of these factors are still in place, and it's showing up in consumer sentiment, and it's also showing up in the consumer balance sheet, which continues to be strong because of lower rates. So what's a Fed to do? Well, our view is still the same. They're going to go low and slow for some time, but markets think it's going to be even lower and slower. So if they have to adjust to the Fed's reality, expect volatility in markets, in particular within your bond portfolios. So how do I build a bond portfolio? As we've said before, be balanced between risk-reducing fixed income and return-seeking fixed income. In the high-grade space, globalize. No country wins all the time, but also hedge your currencies. And an easy way to show why we say that is to juxtapose the bond returns against their respective currencies. And you'll see why within a core space we want more of the former and less of the latter. On the credit side and return seeking, our themes have been to diversify, manage liquidity risk, and avoid crowded trades like triple Cs and bank loans. Another crowded trade that came to the fore this year that we've been watching for some time is energy debt, which has been growing as a share of the high yield index. But not all energy is created the same. We're more focused on the risk in the E&P space because they're most sensitive to prices. During the summer, just about everyone could produce profitably. But as we got to the end of the year, a lot of those folks on that list are in danger, particularly within the fracking space. Now, 2015 is probably going to be a little muddy because prices have been hedged in to some respect and there's cash to spend. But make no mistake about it, there will be winners and there will be losers, and the opportunity is to capitalize there, just as it is within the equity markets. There should be continued strength in returns driven by earnings growth, but the earnings growth will diverge. How do you capture your best ideas, your high conviction ideas? Be concentrated. You can see the strength in performance here by more concentrated portfolios over the past 10 years, so do so. All right, well, let's put this into a larger portfolio context. From the equity side, we've talked about concentrating your portfolio. Also add in risk-reducing strategies. That's a nice balance to have. And we think volatility management is important at this point in the cycle. That's why we like alternatives, but specifically those alternatives that focus on downside protection and active alpha-driven strategies. That includes long-short equities, long-short credit, also special situations and opportunistic that can capture that elevated liquidity premium. And finally, balanced risk fixed income, because it's the same thing that we espouse here within our portfolio. Taken together, this overall allocation is meant to capture two truths about divergent worlds and divergent capital markets. The first is that alpha opportunities are certainly there, but the second is we must protect to the downside. And that can be encapsulated in three tenets that serve investors well over all seasons. As always, be active, be balanced, and be selective. Do that, and we've got a portfolio to get us through the next several years of rising rates and divergent fortunes. And so with that, on behalf of AB, I'd like to wish you a happy and healthy 2015, and I will see you next quarter.